anywhere near where we are now because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now.
Andy Schectman just delivered another wake-up call for every gold and silver investor. He says the moves happening right now in the metals market aren't random noise. They're signals. Gold is quietly positioning for a massive revaluation, and silver is still the most undervalued asset on the planet. While most people are distracted, Andy is watching the big players. Central banks stacking gold, insiders shifting wealth, and patterns that point to an explosive move ahead. His message is clear. If you own gold and silver, you need to pay attention. If you don't, you might miss one of the biggest financial shifts of our lifetime. Keep watching, because up next you'll hear exactly what Andy says in his own words.
You're seeing the numbers in all of vaults, except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But seven-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving. And the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote very possibly that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to really to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately, that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure. Been very adamant about, again, Fed losing independence. Goldman Sachs says the market gets one whiff of that. 1% move out of treasuries is 5,000. What if it's 2%, 5%, 10%? The very wealthy people So here's the thing. He wants to lower rates. Right now, with the 10-year Treasury at 4.5% and the CPI nonsense inflation saying that, okay, well, that's a positive 1.5% or whatever, and we know it's a lie. We know it's a negative yield, real yield. But if he wants to lower it by what he says as much as 300 basis points, well, then even using the same CPI numbers, you're going to be real negative yield in your face, not just the make-believe stuff that they hide on the CPI, but in your face. And the wealthy, sophisticated people ain't going to stand for that. They're not going to do it, period. They will move to gold. And that's why you see big money in central banks, I believe, have been preparing in earnest for this. Look, you're seeing all of this stuff happen without any meaningful retail participation. So, as always, the little man rule done again. The big money is front running what may be a bull market of a lifetime, because in gold's case, it's not gold going higher. It reflects the loss of purchasing power of the currency. This is why when people say, how high can gold go? The answer is, how low can the dollar go? Franz Pick used to say all currencies, fiat, are inherently meant to die. In essence, it could go to infinity. Now, I'm not saying that's going to happen, obviously, but, I just think that people could benefit from diversifying more heavily into gold and silver like the central banks have. Goldman Sachs sees the scope for prices to move well beyond 4,000 as their baseline forecast for next year. And even beyond the 4,500 tail risk scenario. This is, again, no public participation, but if 1% puts their money in of privately owned U.S. treasuries, they're saying 5,000 an ounce. So I don't know. But I just want to hammer it home. If Trump lowers yields by 2 or 3% real yields, it'll be negative. Even by their numbers, big money will not stand for that. That's why they are front running this. The world's largest players, the central banks, the global lenders, the corporations, the global lenders being the commercial banks, the ultra wealthy, they've all been quietly repositioning. But once it becomes obvious that the public will realize that fiat money is eroding, is it too late at that point? I don't know. I'll leave that up to everyone else. A couple last things here. The jobs report. The consensus was that between 40 and 100,000 jobs would largely green light a 25 basis point rate cut. But we would need a massive, massive outlier for the Fed to cut by 50 basis points. Well, we got that outlier. The BLS reported that in August we only added 22,000 jobs, not the 79,000 jobs that were expected. But more importantly, June was revised from 27,000 to negative 13,000. It's the first negative print since 2020. They keep revising these jobs numbers. Remember what happened with July and August, those numbers. To the ugliest part, in my opinion, of the jobs report was the number of full-time jobs. They fell by 357,000 jobs. It's the second consecutive month of full-time job losses, while part-time jobs surged by 597,000. So you lost 357,000 full-time benefit-paying jobs, and you added 597,000 part-time. Kind of seems like people are working 2 or 3 jobs to make ends meet. It gets worse. The number of native-born workers fell by 561,000 to 132.474 million. This was the biggest drop in quite some time. At the same time, foreign-born workers increased by 50,000. The number of multiple job holders soared by over 443,000 to 8.785 million. This was the biggest monthly increase since COVID. And another indication of how stupid the jobs report in the Bureau of Labor Statistics. We should just pull the L out of it, and it should be called the BS. They continue to do this stuff. Now, next week, I think, is it next week? I think it is. They are supposed to revise job growth figures from early 2024 through early 2025. Forecasters have thought that job growth would be slower than previously thought. Now you're getting analysts saying revisions anywhere from 475,000 to 1 million jobs will be revised out. Originally the number was 1.76 million. They're talking about revising 1 million out of the 1.76. I think, let's see, I got maybe 2 or 3 more things left to say. I found it interesting that Trump says that the United States has lost India and Russia to China. And he said, may they have a long and prosperous future together. That's what he came out and said that. And maybe that's because both India and China confirmed to boost their ties to reduce the effect of Trump tariffs at the Shanghai Cooperation meeting. Moody called for stronger relations between the Asian neighbors to minimize the impact of the decisions made by the U.S. without naming Trump. Modi on several occasions called out the West for selfish decisions and vowed that India would never compromise on the requirements of its people, especially their farmers. Not sure what that's all about. I did find it interesting that in an official statement later in the evening said that the SCO had decided to establish a development bank and accelerate consultations on a series of issues related to the financial institution's operation. In other words, this is going to be connected also hand in hand with the BRICS New Development Bank. Now you have the Shanghai Cooperation New Development Bank. Remember, I always said that these would merge, SCO and BRICS. They're going to merge. They have the same goals and largely many of the same participants. India has more to lose by ending its purchase of Russian oil than it does if it stopped trading with the United States. Even though we're their largest trading partner, it amounts to less than 2% of their GDP. 1.9%. I think we're getting to the end. And that is it with the exception of one other thing. We're seeing insured deposits shrink out of the banks. In particular, the regional banks and the small banks. And a lot of money is finding competition with digital banks and stable coins. And wait till you see what happens with all of these stable coins, with fintechs and stable coins offering higher yields and lower fees and instant transfers because they don't have brick and mortar, and they don't have ATMs and all this stuff. We're not out of the woods yet with the banks. And the more we start moving towards this digital system of stable coins, you're going to massively erode the stickiness of bank deposits, and which has been the foundation of bank stability. If the Fed cuts rates, banks are going to earn less from lending, but still need to pay competitive deposit rates, which squeezes the margins and makes the weaker regional banks more vulnerable. Think of Bank of Lindsay, Oklahoma. I don't know. I think that the end of the banking issue is not behind us. If one major institution cracks in confidence, the fallout could be severe because you're going to see a greater concentration of money move out of the small and regional banks, both into the too big to fail banks, like we've always talked about. This is what they want. And also into a handful of these fintech institutions, which again will all be one-to-one backed by U.S. dollars and treasuries. And that is all I got. Happy to answer any questions or any comments. And I made it easy for you today.
If Andy's warning got you thinking twice about where your money's parked, don't just sit back. Hit that like button so more investors hear the truth the mainstream won't cover. Smash subscribe to stay ahead of the curve. And don't forget the bell icon, because when gold and silver finally explode, you'll want to be the first to know, not the last.